Psychology of Money, Part 1. I used to think people acted crazily with money. I'd sit in a coffee shop, watch a guy splurge on the latest phone despite being drowning in debt, and just shake my head with a sigh. I'd hear a friend invest all their savings into some obscure cryptocurrency that just popped up online and find it utterly baffling. But the older I got, the more I realized, no one is truly crazy. They are simply living according to their own logic, shaped by the world they grew up in. Someone born and raised in an era of hyperinflation, where money loses value every day, will view money differently from someone who grew up during stable economic times with high savings interest rates. They act based on their memories, not textbooks. And those memories are often written in sweat, tears, sleepless nights worrying about money, or sometimes, even moments of naive, fantastical dreams. John F. Kennedy, the young American president, was once criticized for never having experienced the Great Depression. He was born into a wealthy family where the crisis was just numbers on newspaper pages, not a haunting fear knocking at the door every night. So when people questioned if he was qualified to lead the economy, it wasn't just a political question. It was a question about memory, about experience, and about how people perceive the world. In the game of money, no one plays with the same deck of cards. Some start with a torn card, some hold a full royal flush. And you cannot expect those two people to make the same investment decisions. How we think about money isn't shaped by Adam Smith's theories or lessons from Harvard Business School. It's forged in childhood, from where we grew up, from how our parents discussed bills over dinner, from the first time we received lucky money or had to borrow money for tuition. And so, each person constructs their own psychological map of money. Some draw it with the winding roads of scarcity. Others color it with the bright hues of opportunity. But that map, whether right or wrong, is what they believe in and live or die by. I remember the first time I saved $500. I was so meticulous, printing out every bank statement, counting every cent of interest. To others, it might have been a small act. But for me, at that moment, it was my first victory after a long time of feeling perpetually in need. So, if someone came and told me to invest everything in stocks because the returns would be much higher, I wouldn't listen. Not because I didn't understand the logic, but because I wasn't ready to trade the feeling of security I had just attained. And that's precisely why I learned a lesson in personal finance. Emotion is king, and everyone has their own king ruling within. Imagine you were born in 1950 in America. When you were 10, the stock market had just entered a 2-decade-long boom. The adults around you were all investing in stocks, and life seemed to get better and better. You learned that the market was a good friend. It knew how to generate profits, how to make those who waited rich. That was your first lesson about money, and you believed it as an undisputed truth. But what if you were born in 1970? You grew up during a time of inflation, unemployment, sky-high interest rates, and oil shocks that turned everything upside down. You saw your parents work tirelessly yet still struggle to make ends meet. You witnessed instability as normal and caution as crucial for survival. You learned something entirely different. Money is easier to lose than to earn, and investing, if not careful, is just gambling in disguise. Neither person, the one from 1950 nor the one from 1970, is wrong. They are simply products of the times they lived in. This is the core message I want you to grasp. Everyone interacts with money according to a story they have lived. And often, that story doesn't align with yours. So before you judge someone's financial behavior as foolish or reckless, ask yourself if you truly know what they have been through. A friend of mine once passed up numerous attractive investment opportunities just to hold cash. He wasn't ignorant. He was simply someone who, as a child, was kicked out of his home because his parents went bankrupt. The feeling of having to sleep in an acquaintance's basement was indelible. For him, cash wasn't about negative interest rates. It was freedom. It was a dreamless sleep. I couldn't argue with yield charts. I could only listen. There's a paradox in personal finance. The more you understand human psychology, the less you want to lecture anyone. You realize there's no perfect formula for money, only personal suitability. And so, instead of seeking the single, right way, you begin to search for your asterisk way, a way that is both reasonable and stable enough for you to live long-term without going crazy with worry. Don't misunderstand me. I'm not saying all financial behaviors should be praised. Some decisions lead to tragedy. but I believe understanding is the first step to change. And understanding begins with humility, knowing that you don't know the full context of others. There's a beautiful paradox in the world of money. If you accept that you don't know everything, you actually gain the ability to understand more deeply. And if you stop trying to fix others, you'll learn to listen to yourself. So, if you see someone spending money foolishly, remember that in their asterisk world, it might be about survival. Bill Gates isn't just a technological genius, he's also a prime example of what's called chosen luck. In 1968, when Gates was a student at Lakeside School, a private institution in Seattle, the school decided to invest in a computer. At that time, this was almost unheard of, as only about 0.01% of schools across the US had computers for students to use. Now imagine Gates hadn't attended Lakeside but a regular public school without computers. He might still have been just as intelligent, just as passionate. But would the world know a Bill Gates, or would he just be some anonymous Bill quietly working at an unknown software company? That's what I call luck shaping outcomes. Now let's look at another side. Kent Evans, Bill Gates' best friend in high school, was in the same class, shared the same passion for programming, and was just as intelligent as Gates. He died in a climbing accident at only 17. No one knows his name, not because he was less capable, but because a random event cut short a path that hadn't yet blossomed. So what determines who succeeds and who is forgotten? Is it talent, hard work, passion? Yes, but there's another variable often overlooked: luck and risk. We like to think that everything happens for a specific reason. The rich are rich because they're smart. The poor are poor because they're lazy. This way of thinking makes us feel that the world is fair, orderly, but reality is far more complex. A wealthy person might have invested in Amazon stock at just the right time when it was only a few dollars. Someone who lost everything might have done so because of a sudden, severe illness that wiped out their assets. Both could be kind, diligent people, but fate charted their paths in unpredictable ways. The problem is that luck and risk often don't manifest clearly. They hide behind similar decisions with different outcomes. Two people open a restaurant. One succeeds because the city happened to lack that type of eatery at the time. The other goes bankrupt because they opened right during a pandemic season. Who was smarter? Who made a mistake? There's no easy answer. And that's why giving financial advice becomes extremely dangerous if we don't understand the underlying context. We see the results, but not the entire chain of causes. We learn from successful people, but forget that hundreds of others did exactly the same thing but weren't as lucky. There's a subtle trap called survivor bias. We read books by billionaires and think if we just do exactly what they did, we'll get rich. But we don't read books by those who failed, not because they didn't want to write, but because no one invited them to. Failure is often silent, success is often loud, and that's what leads us to misunderstand money. Imagine you're a successful investor. Your account has doubled in 3 years. Friends ask for your secret, and you tell them, "I do technical analysis, I read trends, I'm patient." But you don't mention that you also got lucky. You don't mention that when you decided to buy that stock, you simply followed your intuition, and it coincidentally hit big because of information no one else knew that leaked into the market. This is the hardest thing in finance: being grateful for luck but not depending on it, respecting risk but not being paralyzed by it. The problem is that humans hate ambiguity. We want everything clear-cut, cause and effect. Success due to effort, failure due to mistakes. But reality is often success due to 60% effort, 30% timing, 10% luck. Failure is sometimes just due to a small incident no one could foresee. I once interviewed an entrepreneur who had founded 4 companies, 2 successful, 2 bankrupt. I asked, "What did you do differently between the successful times and the failed times?" He replied after a moment of silence, "I did exactly the same thing." It sounds terrifying, but it's the truth. And if you're humble enough to accept that, you'll see the world with clearer eyes. Be cautious when learning from others. Not because they aren't smart, but because they are not you. Your circumstances are different, your starting point is different, your acceptable risk level is different, the era is different. So, advice that works for them might not necessarily work for you. This isn't pessimism. It's a wake-up call for you to build your personal *financial reference framework. Don't copy anyone, and don't arrogantly think you're immune to risk. When you evaluate someone, especially in the world of money, leave room for the factors you don't know. They might have been right, but risk got in the way, or they might have been wrong, but luck lifted them up. If you don't leave that room, you'll live in the illusion that the world can be completely controlled, and in finance, that illusion is the most dangerous thing. Let's start with the story of Rajat Gupta. Gupta, an immigrant from India, once lived in an orphanage, rose to study at Harvard, and became CEO of McKinsey & Company, one of the most prestigious consulting firms in the world. He then joined the ranks of Wall Street's financial elite, serving on the boards of Goldman Sachs and Procter & Gamble. At the time of his arrest for insider trading, Gupta had a net worth of over $100 million. Not $1 million, not $10 million, but $100 million. And it still wasn't enough. He made a phone call, lasting less than 30 seconds, revealing confidential information for a friend to invest ahead of the market. That phone call earned his friend millions and sent Gupta to prison. Why would someone who had everything, money, fame, status, risk it all for just a little more? The answer lies in the title itself. Never enough. Once, the writer Kurt Vonnegut asked his friend Joseph Heller, author of *Catch-22, "Do you ever feel jealous seeing a billionaire make more money in a single day than all your books combined have ever brought in?" Heller replied, "I have something he will never have, enough." Enough is not a number, enough is a feeling. And that feeling, ironically, is incredibly hard to achieve in a world that constantly encourages us to chase more. Look at social media, where every day you see someone traveling to more beautiful places, driving fancier cars, eating at more expensive restaurants. It makes you feel inadequate, even if your bank account is perfectly fine. The problem isn't the number you have, but the comparison points constantly shoved into your mind. In the financial world, greed is a double-edged sword. It can motivate you to work hard, invest, save. But if you don't know when to stop, it will also make you trade your peace of mind for things you don't truly need, just to prove something to others that you may not even believe yourself. And often, that others is someone you don't even like. One of the most important financial skills isn't figuring out how to make the most money, but knowing when to stop. Everyone has their own threshold. That threshold varies from person to person. But the danger is when you don't know where your threshold is, or you deliberately step over it just to see how far you can go. You might win a risky investment game, but if you don't know when to stop, if you keep playing as if luck is a permanent asset, then you are inviting tragedy. The collapse of long-term capital management, an investment fund founded by Nobel laureates in economics. They had at their disposal the most complex models, the most optimal risk control tools, and yet they still went bankrupt. Why? Because they didn't know what enough was. They borrowed too much, leveraged too greatly. They thought they were smart enough to control all market variables. They forgot there are variables that never appear in models: human greed, instability, and unpredictable domino effects. That's when money stops being mathematics. It becomes a test of character. Can you stop when you can stop? The art of enough is not just knowing how much you need, but also having the courage to say no to the rest. In the modern world, where success is measured by outdoing others, being content with your current life can be seen as a failure. You might be rich, you might be secure, you might be free, but if you don't feel enough, you will always live with a sense of lack, no matter how much is in your account. Think of those who got rich too quickly and then lost everything. They didn't lose because they invested poorly, they lost because they didn't know when to stop. And when they lost, they didn't just lose money, they lost their peace of mind, their honor, and sometimes even themselves. Perhaps you don't need to be richer than anyone else. You just need to be rich enough not to worry, and more importantly, enough to sleep well. You might be wise, ambitious, talented, but if you don't know what enough is, you're still playing an endless game. And in that game, there will be no winners, only exhausted players. Let's start with a number. Warren Buffett, known globally as a legendary investor, has a net worth of over $80 billion. But what few people notice is that nearly 97% of that wealth came after he turned 65. Not because he took risky investments, nor because he made big bets, but because he started investing at age 10 and still hadn't stopped past 90. Buffett's power isn't in a drastically different investment strategy, but in the time frame, he allowed his money to work. If he had started at 30 and retired at 60 like an average person, he wouldn't be much different from other good investors. But he let time be his greatest partner. This is where compound interest becomes so incredible that it's easily underestimated. Humans aren't born with an instinct to understand compound interest. We think linearly, today 1, tomorrow 2, the day after 3. But compound interest is nonlinear. Today 1, tomorrow 2, the day after 4, then 8, then 16. At some point, it grows so fast we can't keep up. And precisely because it's slow in the early stages, many people give up before the magic happens. Imagine you plant a tree. In the first year, it only grows a few feet. The second year, a few more feet, you feel disappointed. You compare it to others who plant fast-blooming flowers and you give up. But you don't know that by the 10th year, your tree will be doubling in height every year, and by the 20th year, it will shade your entire garden. That's how compound interest works. But the modern world is impatient with slowness. Investors want quick returns, employees want immediate raises. Social media teaches us instant comparison. And compound interest, the most magical thing in finance, is quiet, slow, unostentatious. It doesn't offer overnight millionaire victories, but it's the sustainable path to living richly without gambling yourself away. Albert Einstein once called compound interest the eighth wonder of the world. Those who understand it earn from it. Those who don't will pay for it. There's a question you should ask yourself. Are you willing to live slightly below your means today, to live beyond your means in the future? If the answer is yes, you are touching the heart of cumulative power. Many people have been rich, and many of them are no longer rich. Why? Because they thought that what helped them make money would also help them keep it. But these two things are like sprinting and running a marathon. Both are running, but the breathing, stamina, and strategy are all different. Making money, especially a lot of money, often requires boldness, optimism, confidence, and risk-taking. You have to believe you're right, even when most of the world tells you you're wrong. You have to invest when the market is fearful. You have to venture down paths no one has traveled before. But keeping money is the exact opposite. It demands humility, defensiveness, skepticism, and patience. You have to think about the worst that could happen and prepare for it. You have to reject big opportunities if the risk feels too high, and sometimes you have to accept missing out on rising waves for long-term safety. Think about Warren Buffett again. He's not just good at making money, what makes him great is that he hasn't lost money. For decades, he's maintained a simple rule. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. Sounds conservative, perhaps. But in investing, conservatism at the right time is an indirect offensive strategy. Because when you don't lose money, you can keep playing the game. But when you lose too much, you're forced to leave. Many people in the financial world have had colossal fortunes, only to see them vanish after a single bad decision. They didn't lose due to lack of knowledge, but due to a lack of what's called a defensive mindset. They risked as if tomorrow would be exactly like today. They forgot that the market, human nature, and even fate can change overnight. And in a world where rare events like pandemics, wars, and asset bubbles are becoming more frequent, survival is more important than winning. There's a very true saying: wealth is the result of making good moves, but sustainable wealth is the result of avoiding bad moves. To keep money, you need 3 things: a little humility, a little skepticism, and a lot of doing nothing. 1. Humility * to admit you can be wrong. Many people lose everything not because they're stupid, but because they're too certain they're right. The market won't go down, Bitcoin can't crash, real estate prices can't fall. These statements sound confident until reality punches you in the face. Those who retain wealth long-term always have a part of their brain dedicated to the question, what if I'm wrong? And they act on the assumption that mistakes are inevitable, only their consequences can be minimized. 2. Skepticism * to doubt even what you're succeeding at. Morgan Housel, a financial writer, knew someone who, despite making millions from the stock market, always kept a large amount of cash in his account, uninvested. When asked why, he replied, "Because I don't know what's going to happen next." That wasn't fear. That was a profound understanding that the market doesn't care about you, and the world doesn't need a reason to turn upside down. 3. Doing nothing, an art few people learn. When you have a reasonable plan, sticking to it, however boring it may seem, is a form of courage. People often think wealth requires constant action, buying, selling, rotating, seizing opportunities. But truly wealthy people, long-term, rarely change their strategy. They understand that acting out of fear or boredom are the two biggest enemies of wealth. Survival isn't glamorous. It doesn't make headlines. No one praises you for doing nothing. But if you can survive long enough, you'll see everyone else eliminate themselves from the game. And sometimes, just staying at the table is how you win. Don't think you're invincible. Don't assume the past will repeat itself, and don't forget that not losing money is a victory. Out of over 21,000 stocks listed in the US from 1926 to 2016, only about 4% of them generated all the net returns of the entire market. What does that mean? It means the vast majority of stocks generated no significant returns, and many even caused losses. But just a very small number that surged dramatically, like Apple, Amazon, or Google, were enough to pull the entire market up. This is the effect of tail events, the rare times a coin lands on tails, but when it does, it wins big. This phenomenon is an asymmetrical distribution, where the majority of results come from a minority of causes. Understanding this gives you a huge psychological advantage in investing and in life. Take Jeff Bezos as an example. He once asked Warren Buffett, "Your investment strategy is so simple, why doesn't everyone follow it?" Buffett replied, "Because no one wants to get rich slowly." That's the truth. Most people want every investment decision to be profitable, but the real world is different. Most decisions will be average, a few will be terrible, and a very small number will be incredibly successful. And it's these few that pull the entire portfolio up. Similarly, in life, most conversations you have won't change anything, but just one encounter with the right person, a partner, an opportunity, a fateful handshake can turn your entire life around. The problem is, you don't know in advance which tail event will be the big win. You can only create the conditions for many coin tosses to occur, then wait patiently. This goes against our intuition. Because humans like stability, we hate the feeling of failure. We want every step to be certain. But when you understand that the distribution of outcomes is always skewed, you learn to accept failure as an integral part of success. Look at Walt Disney. Before establishing Disneyland, he suffered major failures with numerous projects, even sleeping in his office because he couldn't afford rent. But one idea, at the right time, created a giant entertainment empire. If he had given up after the third failure, we would never have Mickey Mouse. Imagine you're playing a coin-tossing game. The probability of landing on tails is 1/10, but if it lands on tails, you get 1 billion Vietnamese dong approx. $40,000 USD. If it lands on heads, you only lose 10,000 Vietnamese dong approx. 40 cents USD. Would you play? An average person might hesitate. A wise investor would play for life. Not because he's sure to win immediately, but because he understands the odds are stacked in his favor if he has enough time and doesn't give up early. This is how the financial world often works. You don't need to be right frequently, you just need to be right a few big asterisk times. And to do that, you have to accept a series of small mistakes, unprofitable investments, wrong turns, without letting those things destroy your confidence and your larger plan. Venture capitalists, for example, they invest in dozens, even hundreds of startups, but they don't expect every deal to be profitable. In fact, they know most will fail. Just one or two unicorns, like Facebook, Uber, or Airbnb succeeding, are enough to offset all losses and generate huge profits. That's the art of enduring a forest of failures to harvest one sweet fruit. But this is something very few people can do because it goes against the instinct to control, to be safe, to win consistently. The average investor is easily defeated after a few consecutive failures and leaves the game right before the big tail event comes. Like a mountain climber who can overcome 99 dangerous sections only to collapse at the 100th, not because of weakness, but because of a lack of perseverance. The irony is that all great successes are anomalies, yet we always demand frequent and consistent results. And precisely because of this, many people give up too soon or become skeptical without ever seeing the big picture. Design your financial portfolio, life strategy, and decision-making process as if you know you will be wrong frequently. but you only need to be right a few times for life-changing results. And above all, you must protect yourself enough to survive until that opportunity arrives. Because big wins are rare, but they are only for those who remain seated after all the small failures. Imagine you're sitting in an air-conditioned office. Your bank account is large enough for you to quit your job, but tomorrow morning you still have to wake up at 6:30 to attend a meeting with someone you dislike, present a report you don't believe in, and nod along to a plan you completely disagree with. Do you feel rich? Freedom, the ability to control your time and decide what you do, when you do it, with whom you do it, for how long you do it, that is the most valuable, rarest, and most worthwhile form of wealth in life. This isn't a philosophical statement, it's a very practical observation. Most truly happy people I've met aren't the ones with the most money, but the ones who can say no to things that weigh them down. That could be a freelance father who accepts just enough income to pick up his kids from school every afternoon. It could be a couple who turn down promotions to spend their summer vacations cycling cross-country. It could be someone who chooses to live in a rural area with lower costs just for peace of mind. What do they have in common? They control their schedules, and that isn't an asset on a balance sheet. It's what brings deep inner wealth. Morgan Housel tells a story from a trip to New York. He saw a man driving a luxurious car, stepping out of a Lamborghini, attracting admiring glances from the crowd. But he realized the paradox. People weren't admiring the driver at all. They were imagining themselves behind the wheel. In other words, people didn't admire the driver. They admired the asterisk car itself, the image it evoked, which is what others wanted to possess. That's a very common illusion. We think spending money will make others admire us. But in reality, others aren't thinking about you at all. They're only thinking about themselves if they had what you possess. And if you spend your whole life chasing external validation, forgetting to ask if you're living the way asterisk you want, then no matter how much money you have, you are not free. Think about the things that stress you out the most every day. It could be meaningless meetings, late-night emails, favors you don't want to do but agree to out of politeness. Each time, you trade a small piece of your freedom to maintain a feeling of safety, to be liked, or simply to avoid trouble. And then one day, you look back and realize you've lived someone else's life with your own time. The ability to say no without explanation, without apology, that is the rare power of the truly rich. Paul Graham, the founder of Y Combinator, once said, "Real wealth is the ability to do whatever you want, whenever you want, with whoever you want, for as long as you want." And if you don't have that, then even if you have millions of dollars, you're still living in a different kind of poverty. Sounds a bit extreme, perhaps, but try to verify it. Is someone with a high income who works 12 hours a day under stress, afraid to take vacation, scared of losing their position, truly rich? Compare that to someone with a moderate income who has time to write books, plant trees, pick up their children from school, read their favorite books. Who is living a richer life? Freedom doesn't mean living lavishly. It means actively arranging your life according to your asterisk values, instead of letting life arrange asterisk you according to someone else's schedule. One of the smartest forms of saving isn't saving for a specific purchase, but saving to buy control over your time. When you have a large enough financial cushion, you're no longer forced to take a bad job, tolerate a rude client, or bow down to an autocratic boss. You can choose, you can negotiate, you can leave, and that is freedom. It's fascinating to think that money, which is often seen as the goal, is actually just a tool, and the real goal is time. The poorest person is the one bound by others' time. The richest person is the one who buys back their own time. Imagine you could spend your entire Monday morning reading a book just because you like it. No reason needed, no one's approval required, no flood of emails, no crushing deadlines, just you and that peace. If you're living like that, congratulations. You're richer than most of the world. Freedom is the only thing that, once tasted, you never want to live without. And if you're saving, investing, accumulating, remember that you're not just accumulating money, you're buying back yourself. A man driving an expensive sports car turned at an intersection. The engine roared as if announcing something to the world. Passers-by turned to look, but no one exclaimed, "Oh, that car owner is so cool." Instead, the only thing they thought was, "I wish I were in that car." The man thought he was making an impression. But the truth was, no one cared about him. All eyes glided past him, fixed on the car. The car made the impression. He was invisible. That's the paradox. You buy expensive things for others to respect you, but they only see what you buy, not who you are. Morgan Housel calls it the man in the car paradox, and it happens everywhere, all the time, with everyone. You can wear a designer shirt, a $1 million watch, use a foldable phone that looks like it's from the future. But no one truly thinks better of you for it. They just imagine they would be cooler if they had those things. You are the means, not the end. I know this sounds a bit cruel, but it's worth pondering because it strips bare one of the most dangerous unconscious motivations of modern humans: validation. We don't spend money out of need. We spend money to project an image, a silent declaration. I've succeeded, I'm respectable, I'm not as ordinary as you think. And then no one cares. You trade money for attention, but what you receive is only superficial, temporary, and always misplaced attention. I once thought I'd be respected if I bought a high-rise apartment overlooking the river. I imagined my friends would be amazed. But when they came, they only asked, "How many square meters is this apartment? The price must have doubled by now, right?" And then they scrolled on their phones. No one truly saw me in that apartment. They only saw a financial asset. I realized that to be respected by others, the fastest way is to respect myself without needing them. Not through possessions, but through my way of life, my way of treating others, my way of thinking. There's a kind of luxury that doesn't need to be displayed. It lies in how you refuse to compare, how you smile when others show off, and how you choose quietness over noise. The most impressive person isn't the one who owns enviable things, but the one who doesn't need to use them to prove anything. It's hard to live this way because every advertisement, every social media post, every whisper from our own insecurities tells us the opposite. But think about it. If you're truly confident, you don't need to prove anything. And if you don't need to prove anything, you're freer than the person in that roaring supercar, hoping someone will notice them, when no one truly does. When I worked as a valet at a luxury hotel in Los Angeles, I had the chance to watch Ferraris and Lamborghinis glide into the entrance like a silent yet intense show. I imagined I was standing before people at the pinnacle of success, living symbols of wealth. But then, time and the stories I overheard peeled back layers of that admiration. I remember one person, let's call him Roger, young and dapper, stepping out of a Porsche. Every time Roger arrived, all eyes followed, until one day he drove an old Honda. And then the next day and the day after, I asked. Roger replied nonchalantly, the Porsche was repossessed by the bank, went bankrupt. No shame, no drama, as if he was recounting a boring detail from the weather report. That's when I realized a paradox. The luxury car you see on the street doesn't prove its owner is rich. It only proves they have at least that much money, or are in debt that much to own it, and very likely, that's all the assets they have. We often judge wealth based on what's visible: cars, watches, mansions, Instagram posts. But true wealth is what you can't see. The money not yet spent, the choices not yet made, the freedom being saved. Truly wealthy people don't surprise you with their appearance. They live modestly, quietly, like Ronald Reed, a janitor in Vermont who lived so simply that no one guessed when he died he left over $8 million. Not from winning the lottery, not from inheritance, but from saving every small paycheck and investing silently for decades. He didn't need anyone to know, didn't need anyone's admiration. He needed stability. The problem is, because we don't see wealth, it's hard to learn how to become wealthy. It's like trying to write literature without ever reading it. Where do you learn from? Who do you learn from? We are easily captivated by people who look rich. But what we see in them is wealth that has been spent not wealth that has been retained. The expensive watch on their wrist is proof of one thing: that money is no longer in the bank. Rihanna, the global superstar singer, almost went bankrupt due to uncontrolled spending. When she sued her financial advisor, he simply replied, "I need to tell you that if you spend money, you will have things, not money, right?" We laugh, but it's true. When someone says they want to be a millionaire, what they really want might be to spend $1 million. And by doing so, they are going against the very definition of a millionaire. Wealth isn't the feeling you get when you drive a flashy car. Wealth is when you have the power to refuse it and still feel fulfilled. What makes modern consumerism dangerous is that it turns showing off into a celebrated industry. Social media makes it easier than ever for people to pretend to be successful. You just need a photo angle, a borrowed trip, a rented car for a few hours. And then you're admired. But that admiration is hollow because no one truly cares about you asterisk. They only dream of being an asterisk your asterisk position. When I was a valet, seeing someone step out of a Ferrari, I didn't think that person was great. I only thought, I wish I could drive that car. You think you're getting attention, but actually it's just the car that's being dreamed of, not you. This is a silent tragedy of our time. We rush to buy expensive things to impress others, but most of them don't care. Or if they do, it's only because they're imagining themselves as you, not genuinely respecting you. So why not stop? Why not choose a path with less applause but more sustainability? Wealth, in its most subtle definition, is refusing to spend money today to retain options for tomorrow. Wealth isn't high income, it's the ability to control yourself. It's when you asterisk can asterisk, but you choose not to. To understand the true value of wealth, you must leave the stage. That place is too noisy, too many lights, and too many whispers of competition. You need to go backstage, where truly wealthy people live very different lives, no showing off, no proving anything, no need to impress anyone. One of the hardest things modern people have to learn is to feel asterisk enough when no one is watching. You can save, invest, live below your means, resist temptations. But if no one applauds, no one admires, can you still continue? If the answer is yes, you are building a kind of wealth that cannot be measured, inner resilience. That wealth gives you the ability to endure tough times. It gives you the right not to worry when crises hit. It gives you the standing to refuse lucrative offers that don't align with your values. It gives you the freedom not to depend on anyone else's gaze. And most importantly, it gives you peace, something no luxury item can buy. Spend money like someone who knows exactly why they're spending it. For genuine joy, not for attention. Spend as a reward for self-control, not as an excuse to temporarily escape insecurity. Wealth isn't a destination. It's how you walk. It's knowing that if everything falls apart tomorrow, you'll still stand firm because you don't rely on anything too easily lost. And wealth, sometimes, is simply the ability to be silent in a world screaming for you to spend more. You can start that today. No one needs to know, no one needs to confirm, no one needs to admire. Just you, looking at your wallet, then at yourself, and smiling. I don't need more than this to feel at peace. We live in an age where people can borrow money to buy everything and pay for it tomorrow. You might not be able to afford it yet, but that sofa, the new iPhone, or the Bali trip are still available to you with just a click. And so, saving, the behavior that was once the foundation of an entire generation's livelihood, has become like an obsolete antique, unattractive, and somewhat pitiful. You don't need to learn investing, don't need to wait for the market to go up, don't need to get lucky with a trend. You just need one decision asterisk, not to spend that money today. The interesting thing is, you can get rich without increasing your income. You just need to increase the gap between what you earn and what you spend. The difficulty lies in that gap. That space between asterisk can spend and choose not to spend is the territory where greed, ego, comparison, and social media temptations squeeze in. A wealthy person isn't someone who earns $100 million a month and spends $95 million. A wealthy person is someone who earns $15 million, spends $7 million, and sleeps well. You might think saving is for when you face difficulties. True, but only partly. Saving is also how you buy flexibility, buy the right to refuse, buy the ability to say no, buy the freedom to change direction when life takes a turn. Morgan Housel's friend once quit his job without worrying, even though he didn't have a new one. Not because he was rich, but because he had saved enough to live for 12 months without a salary. That amount wasn't huge, but its meaning was priceless. It's a soft cushion between you and life when it gets rough. Saving is a form of personal insurance you design yourself. No contracts, no salespeople, no premium packages. It just requires you to take a step back from today's temptation to have more confident steps tomorrow. While investing is influenced by many things you can't control, the market, interest rates, the global economy, saving is entirely in your hands. And therefore, it is the most powerful act of self-reliance you can perform. There's something most people don't dare admit. Most of what affects our financial lives is unpredictable. Losing your job due to company cuts, your child suddenly falling seriously ill, the stock market plummeting due to an unforeseen virus, interest rates doubling in just a few months. You can't write those things into a financial plan, but you can save to withstand them. And that's why saving isn't just a habit, but a philosophy of life. It's how you view the world, not through a pessimistic lens, but with humility. You save not because you're fearful, but because you understand that life doesn't owe you a smooth path. Smart people don't measure their stability by income, but by the gap between income and expenses. The wider the gap, the better you can cope when unforeseen events strike. And the paradox is that those who live with this gap are often the least noticed. They don't show off new houses, new cars, new vacations. They are quiet, but that very quietness is proof of a sustainable intelligence. They know that every dollar saved today is a vote for tomorrow's freedom. Saving is also a way to avoid becoming a slave to unwanted situations. You can work for passion instead of pressure. You can leave a toxic environment instead of gritting your teeth and enduring it for fear of losing income. You can try a new path without risking your entire life. And most importantly, you can sleep well, knowing that if something happens tomorrow, you have a cushion. Many people think saving is a sacrifice. Saving isn't about giving up what's good, it's about choosing what's asterisk better in the long run. You're not buying that item today, true, but you just bought an extra week of rest when you need it. You're not upgrading your phone, true, but you just bought a year free of debt. You're not living life to the fullest like others. True, but you just bought the right to live life your way without anyone's permission. And that is true luxury. In academia, personal finance is a game of pure logic. If you spend less than you could earn with higher returns, you're foolish. If you don't optimize taxes, you're uninformed. If you keep money in a savings account instead of investing, you're letting money die. But then you meet someone like you, like me, someone who is willing to pay off their mortgage early, even with extremely low interest rates. Someone who forgoes investments to keep cash. Someone who refuses to optimize returns for peace of mind. And you think they're irrational. In reality, they are simply living reasonably asterisk. Living reasonably means you understand that you are a human being, not a purely calculating machine. You have emotions, you have memories. You have sleepless nights filled with worry, invisible fears that can't be discounted by an Excel model. And you interact with money based on all those things. And that's not wrong. People often ask me if they should invest if they're afraid of risk. The answer isn't in a formula. It's in your ability to endure the emotions when the market is in the red. You can be rational enough to invest 100% in stocks, but if you panic and sell at the bottom, you've just ruined your own ideal plan. Morgan Housel and his wife decided to pay off their mortgage entirely, even though the interest rate was extremely low. Theoretically, it was a bad decision, because they could have invested that money and earned more. But for them, a debt-free home was a spiritual foundation, a sense of peace, the feeling that we have a place no one can take from us. And the value of that peace is not in a profit spreadsheet. Living reasonably is when you realize no financial plan survives intact after you fall into an emotional crisis. Not eating out, not going out, not buying anything that doesn't generate profit, not doing anything for pleasure if it's not profitable. Such a person might maximize assets but might also lose the joy of living. Whereas the person who lives reasonably might not be the richest, but they go the distance. In an ideal world, everyone saves at the correct rate, invests at the right time, diversifies appropriately, and never reacts emotionally. But you know who lives in an ideal world? Computers. Humans don't live there. Humans live in a world where fear rises at midnight, where a family argument makes you sell all your stocks, where childhood memories of poverty make you never dare to take risky investments, no matter how high the interest rates. That's why rationality is the foundation for longevity. Not because it yields maximum profit, but because it is sustainable. It's like a diet. The best diet isn't one that helps you lose 5 kg in a week, but one you can maintain for 5 years without going crazy. Finance is the same. Sometimes saving too much makes you feel guilty every time you spend on yourself. Sometimes investing too aggressively makes you always live in a state of needing to win. And if you don't win, you break down, you lose faith, you give up. Meanwhile, an average investor with a reasonable strategy aligned with their personality often gets richer in the long run because they are persistent, don't force themselves, and aren't shackled by their own plan. Morgan Housel once spoke with someone who only invested in bonds, never touching stocks, because he couldn't tolerate the volatility. Theoretically, that's a mistake. But that person lived through two major financial crises without selling anything off. His account was stable, his mind was stable, and he slept well. And in investing, sleeping well is a form of return. Living reasonably means you adjust your finances to your actual emotions, not the assumed emotions of an ideal investor. The goal isn't to act mathematically correct, but to survive long enough for compounding to do its magic. A plan that's 80% reasonable, but you stick with for life, is infinitely better than a 100% optimal plan that you only follow for 3 months and then give up on. Try to look back. Did anyone predict the Great Recession of 2008? Could anyone imagine the global financial market almost freezing up just because trust crumbled? And if someone did predict it, could they have predicted the exact reason, the exact timing, and the exact consequences? The answer is no. The most important events, both in history and in individual lives, are often unexpected. We cannot plan for them. And precisely because of that, we are never taught how to mentally prepare to receive them. That's why Morgan Housel wrote, "When you study history, you don't learn what happened, you learn what people remembered happened." We read financial books as if the past is an accurate map, where we just need to retrace old steps to reach our destination. But in reality, each era has a different psychology, a different fear, a different madness. What shapes finance isn't data, it's human emotion in specific circumstances. Think about 2020. The pandemic hit, global lockdowns, markets plummeted, and then recovered so quickly that many experts were baffled, unable to explain it. No model predicted that, because models don't account for the desperate psychology of a world confined indoors, ready to invest savings into anything that offered hope. You can study the past, but if you don't understand the emotions, the surprises, and the unpredictable parts of it, you're learning it wrong. We like certainty. We want to believe there's a right path, a standard formula, a secret that applies at all times. That mindset easily leads you to complacency, which will kill you when the unexpected happens. Money, in most of its decisive moments, follows no rules except the unexpected. Imagine you're investing and you spend a year analyzing economic variables. You read reports, track interest rate policies, even hire experts to forecast the market. But then, from some corner of the world, a virus appears, or a tech scandal, or political instability. You don't see it coming, no one does. But it wipes out every model, every prediction, every expectation. What truly shapes the financial world are things that have never appeared before. And that leads to a profound paradox. The data you learn from the past won't help you in the future if the future is guided by things the past has never witnessed. Throughout the 20th century, no document or model predicted the collapse of Lehman Brothers, an event that triggered a global crisis. Why? Because it was a combination of cleverly concealed greed, a complex mechanism no one fully understood, and a chain of human emotions: panic, denial, despair erupting simultaneously. All of it went beyond Excel spreadsheets. Every important financial lesson is born from lived experience, not from models. This means you can be a mathematical genius. But if you've never lost sleep over a collapsed investment, never panicked amidst a red market, then you don't truly understand finance. In your plan, leave a provision for uncertainty. Not a financial provision, but a provision in your mindset, attitude, and the ability to accept the truth that you don't know everything. It's like driving at night on a country road with no lights. Don't drive at high speed as if you know the road by heart. Leave room to react in time if something unexpected appears ahead. And if you think surprises are rare, think again. Most major turning points in life aren't on the schedule. Losing a job, getting promoted, marriage, divorce, illness, war, unexpected luck. Surprise is the structure of life, not its anomaly. The difficulty is that the human brain likes logic, likes forecasts, likes certainty. And because of this, we often confuse the feeling of control with actual control. The more confident you are that you know what will happen, the more vulnerable you are when it doesn't. Remember, the financial system is also a living organism, controlled by billions of human emotions simultaneously. And as in any emotional crowd, chaos is inevitable. So, what is a wise way to live in an unpredictable world? It is to live with a flexible mindset, ready to change when necessary, respecting ambiguity, and leaving room for the unknowable. Don't learn finance like math. Learn it like parenting. You can read hundreds of books, but when the child cries for the first time, that's when you truly begin to understand. That's not an easy pill to swallow. But if you want to survive long-term on this improvised stage, you need to learn to dance to the rhythm of things no one taught you before. Everyone loves to talk about strategy. People are obsessed with optimizing returns, comparing growth charts, debating ideal buying and selling times. But few are willing to talk about this. You can be wrong, and you can be very wrong. The question isn't whether you will be wrong, but how you will manage when you are wrong. In the aviation industry, safety doesn't come from completely avoiding risk, but from building redundancy for it. Every plane has dozens of backup systems, redundant wiring. Pilots are trained for the worst-case scenarios, yet in finance, people often fly with a single engine. Every investment plan that doesn't account for errors, even small ones, can completely collapse. Errors aren't failures, errors are certainty. And so, the wise thing isn't to try to avoid being wrong, but to design your financial life so you can still live well when you're wrong. Morgan Housel tells of Ben Graham, Warren Buffett's teacher, who once said he didn't seek maximum returns. He only needed a strategy that couldn't be destroyed under any scenario. That's the essence of room for error. Don't invest everything, don't borrow to the point of no return, don't believe you're entirely right. And the paradox is here. Those who have a large margin of safety are often the ones who are richest in the long run. They aren't the fastest. They don't win every battle, but they aren't eliminated from the game. Conversely, those who pursue maximum returns often optimize so much that there's no room left, and with just one slip, everything collapses. Recall 2020, when the stock market fell by tens of percents in just a few weeks. Some panicked and sold. Some, with too much leverage, went bankrupt. Some invested borrowed money and lost everything. But those who had room for error, those with enough savings for 6 months, those who only invested truly spare money, those who lived below their means, they didn't just survive, they had the opportunity to buy when others were fearful. No room for error means you're living by an illusion. And in fact, room for error isn't just a financial concept, it's a philosophy of humble living. It's the acknowledgement that I am not smarter than the market, not invincible, not immune to mistakes. And so, I design my life like a boat with enough flotation devices, not just to sail fast, but not to sink when the waves are high. Try to think back. 5 years ago, what did you confidently assert that you no longer believe today? 10 years ago, what did you want that you no longer desire? The illusion of an eternal self. We believe that our current version is the final, complete version, as if from now on we won't change. But what's the reality? Your self is a flow, not a fixed stone. We change our views, life values, how we feel happiness, and even our fears. What keeps you awake tonight might have no impact on you 3 years from now. What you crave today might become something you laugh about remembering. So, if you yourself are a constantly shifting variable, how can you write an immutable financial plan? Leave room for your future self, the person who won't be like you now. For example, you might plan to retire at 55 to travel the world. But by age 55, what you want might be a quiet garden and afternoons reading books. Or vice versa, you think you'll like minimalist living, but then realize you crave the feeling of playing big one last time. This isn't about right or wrong. It's about humans changing, and instead of fearing that, be humble when planning. Don't nail yourself to a single vision. Even financial goals should be flexible. Don't create a 30-year plan with such certainty as if you're writing your will. Instead, periodically ask yourself, am I still the person who wants these things? Flexibility isn't a sign of indecision, it's a sign of maturity. You don't need to have lifelong goals at age 25. You just need goals clear enough for this year and the sensitivity to adjust as you become a new version of yourself. You're standing at a big intersection. You choose a path and walk decisively. But after a few miles, you realize this isn't where you want to go anymore. What stops you from turning back? Not reason, but the ego that has already committed. We tend to cling to old choices, not because they're still right, but because we're afraid we were once wrong. We don't want to admit that today's self is different from yesterday's. And so, we keep an outdated plan just to protect our ego. Being true to yourself is good, but only if you understand that Yourself is a changing entity. Treat your financial goals as temporary assumptions, not unchangeable vows. For example, if you set a goal to buy a very large house at age 30, but by 35 you find yourself happier in a small apartment, don't let the past bind you to a 25-year mortgage just because that was once your dream. Money isn't a measure of loyalty to your old self. Money should be a tool to serve the better version of yourself you are becoming. And paradoxically, flexible people are often more persistent because they aren't immersed in illusion. They understand that change is the rule, and accepting it is a form of inner strength. Many people cage themselves in a financial plan that's logically correct but wrong for their human self. They pursue a goal that no longer makes them happy simply because they feel they've gone too far to turn back. But in reality, turning back isn't failure. It's the courageous act of someone who dares to live true to their present self. Design your financial life as if you're talking to yourself 20 years from now, with all the curiosity and compassion. You don't know what that person will think, want, or fear, but you can leave them enough flexibility to decide again. And perhaps true wisdom isn't about finding the right path from the beginning, but about always being ready to adjust when you realize you're going off course. The stock market. People often say that if you invest long-term in the S&P 500, you'll get an average return of about 10% per year. Sounds simple, reasonable, pleasant, but they forget to tell you the asterisk cost of it. What's the cost? It's the patience when the market drops 30% in a month. It's the ability to sit still when the news screams that a great recession is returning. It's the infuriating feeling when your account value halves and you don't know if it will ever recover. That's the cost, and you cannot avoid it. The problem is that because this cost isn't printed on a label like in a supermarket, many people assume it doesn't exist. They invest, then panic when the market fluctuates. They call it risk, a mistake, a scam. But in reality, they're just facing a cost they never agreed to pay. Every return has a cost. The question is, are you willing to pay that cost and endure it long enough to receive the reward? Some people are willing to pay for university because they clearly see the tuition, but they aren't willing to endure the pressure in investing because they don't see the invoice. That's a distortion in the perception of value. A reasonable cost is never cheap, and a cheap cost often has hidden expenses. If you don't pay with emotion, you'll pay with mistakes. If you don't pay with time, you'll pay with opportunities. If you don't pay with patience, you'll pay by buying high and selling low. The cost is unavoidable. You just choose to pay it up front or have it demand its due later. Sometimes you have to wade through mud, endure hunger, cold, climb uphill without seeing the destination. That's not your fault. That's the entrance fee to reach the summit. Imagine you're sitting in a meeting room amidst a record stock market decline. The index is bright red, investment accounts have evaporated hundreds of millions of dong. The person next to you whispers, "Surely we have to sell." At that moment, your mind isn't thinking about probability theory or compound returns. Your mind thinks, "I'm losing money. If I continue, I'll lose more." And that's the moment the market doesn't need you to be smart. It needs you to endure. The cost of returns is uncertainty, discomfort, and lack of recognition. It's not like university tuition, where you pay, get taught, then receive a diploma. The market doesn't teach you clear lessons. It just throws you into the rain and waits to see if you retreat. If not, you survive. If so, you've paid tuition but received nothing. Many people give up on investing not because they miscalculated. They give up because they weren't mentally prepared for the pain. They think investing is a straight path. Just follow the right steps and you'll reach the goal. But they forget this path is full of psychological landmines and no signposts. And when fear arises, they look for free solutions. They jump from one strategy to another, seeking new secrets, new gurus, hot stocks. But no solution erases the fundamental cost, enduring uncertainty without crumbling. Just as in life, you want a stable relationship. The cost is patience during disagreements. You want a meaningful career. The cost is days when you're unsure if you're doing the right thing. You want financial freedom. The cost is times when you're misunderstood, lonely, and wondering if you're wasting your time. Everything has a cost. The question is, do you see it and agree to pay it? Don't shy away from the cost. See it as an entry ticket. See discomfort as part of the experience, not a signal that you're wrong. Like an athlete, you don't demand an easy race. You just need to know that every painful step is a step bringing you closer to the finish line. A man in his 50s who has lived through 2 major financial crises, seen friends go bankrupt, even sold his house due to debt. For him, the stock market isn't a place to get rich but a minefield full of dangers. Meanwhile, you, born after 2000, witnessed the market's rapid recovery after the pandemic, where crypto and tech stocks doubled in just a few months. For you, the market is a place of opportunity, of freedom, of making money even while sitting still. Two people, two histories. Both look at the Dow Jones Index. One sees danger, the other sees opportunity. Who is wrong? Neither. Everyone makes financial decisions based on their own experiences, not theories. And this is more important than you think because it means the financial market isn't where logic holds absolute sway, but where personal stories clash, conflict, and coexist. Remember, for a young person, debt can be smart leverage. For someone nearing retirement, debt is a danger to avoid. For someone who lost everything due to speculation, cash is king. For someone who just hit big with crypto, cash is a wasted opportunity. Every piece of advice comes from somewhere, and that might not be where you're standing. Be careful with advice that sounds right. Because if it doesn't consider your context, age, income, values, financial experience, it might not just be useless, but dangerous. Just as in life, you can't apply a New York billionaire's parenting methods to a single mother's situation in Can Tho, a city in Vietnam. Not because one is right, but because context creates logic. Look at a financial market chart. The price line fluctuates continuously like a heartbeat, never stable. Every ripple on it isn't just a number, it's a human decision. Someone bought, someone sold at the same time at the same price. What does that mean? It means two people look at the same data but have two different stories in their heads. One thinks, this is the bottom, a great opportunity. The other thinks, this is the peak, I have to get out before it's too late. And the wonderful or terrifying thing is, neither is crazy. They simply come from two different worlds. People don't act foolishly. They act reasonably according to what their life story tells them they should do. If you don't understand that, you're very likely to despise, judge, or wrongly imitate others. Why did that person sell shares when the price was rising? Or why did they hold cash when interest rates were low? Or why did they refuse to invest in real estate when prices were hot? And the answer is always, because they are not you. They might be worried about losing their job, or caring for a sick relative, or have just survived a personal financial crash, or simply need cash to live now, not profits 10 years from now. And if you don't realize that, you'll easily imitate people acting in a completely different context from yours. You read an article, see famous investor X selling off stocks, and you follow suit. But you don't know they need liquidity to buy another company, or they have millions of dollars in cushion behind them, or they're simply playing a game whose rules you've never known. You don't need to be right in the way others are. You just need to be right in a way that suits your life. And that is true freedom in finance, not being pressured by what others do because you know it doesn't apply to you. The market is a mosaic where everyone holds a small piece and thinks they see the whole picture. But you only see the whole picture when you understand that other pieces are also reasonable, even if they're not like yours. And only when you accept that difference will you not be swayed. The market is about to crash, financial crisis is coming, the monetary system will collapse. Immediately, the room falls silent. People listen, take notes, share, discuss. Now imagine another person stands up and says, everything will be fine, the market will recover. Humanity will adapt and thrive. The room sighs, nods, then dismisses it. Pessimism seems wiser. Optimism sounds like empty platitudes. That's the allure of pessimism, and it has such a powerful pull that it makes you surrender even when you don't need to. The reason is simple. Pessimism taps into your defensive instincts. For millions of years of evolution, our ancestors survived by always being suspicious, always cautious, always thinking about the worst. The overly optimistic might have died eaten by tigers. The slightly pessimistic survived, and that gene passed down to you. As a result, you always react more strongly to negative information. You share bad news faster than good news. You remember market crashes more clearly than recoveries. You watch the news to be vigilant, not to be comforted. And that makes you feel that the world is getting worse, even though in the past 100 years, humanity has achieved unprecedented growth in history. Companies listed on the S&P 500 have overcome 2 world wars, the Great Depression, oil shocks, the Cold War, the dot-com bubble, the 2008 crisis, the global pandemic, and continue to grow. But people don't remember that. They remember, that time I lost 30% of my assets in just 1 month. Pessimism leaves a mark, optimism fades away. Pessimists are often seen as profound. They write lengthy analyses, intertwining history, warning of collapse, using words like unsustainable, highly likely, and omen. People read it and find it reasonable, logical, credible. Meanwhile, optimists are often considered simplistic, naive, or ignorant. Why? Because in the short term, pessimism is more accurate. Markets fall faster than they rise. Crises come unexpectedly and are shocking, while growth always comes slowly, quietly, and is often taken for granted. Economic recovery is like gentle rain on a rooftop, soft, steady, and easily overlooked. A crisis is like a thunderclap tearing the sky, you'll remember it forever. And that's why many investors give up right at the beginning. They are poisoned by pessimism and don't get to taste the sweet fruit of time. Over the past 50 years, every decade has had rational reasons not to invest. The Cold War, inflation, oil crises, sovereign debt defaults, dot-com bubble, 9/11, 2008, COVID. But if you patiently endured through it all, you didn't just survive, you got rich. Optimism isn't believing that everything is always good. Optimism is believing that even when things are bad, we will learn how to deal with them. That's the kind of optimism not of a dreamer, but of someone who has failed, been scared, lost, but still continued. Pessimism is the loud voice of the present, but optimism is the long-term whisper of history. Optimism isn't appealing. It doesn't create shocking headlines, but it builds wealth. It doesn't create viral videos online, but it creates sustainable happiness. Every day you maintain faith not in perfection, but in resiliences, a day, you move closer to the rewards others only dream of. Recall a time you lost heavily in an investment. Your account evaporated, you were anxious, worried, couldn't sleep. In that moment, you didn't need a chart, a probability formula, or a macroeconomic analysis. You needed a story that explained why it happened. This is due to the trade war, because the Fed raised interest rates, because big tech was manipulated, because Bitcoin just crashed. Whether true or false, those stories provided a sense of control. As if understanding the reason means we can prevent it next time. The danger lies here. We easily believe any story as long as it helps us feel less anxious. If a story is repeated often enough, passed from person to person, printed in newspapers, blogs, podcasts, it becomes a social truth. No evidence needed, no logic needed, just a feeling of being reasonable. Remember the dot-com bubble in 2000. People believed any company with com would rise in price. Then in 2008, real estate always increased in value. Then crypto was the future. It couldn't be wrong. Every financial craze starts with a story that sounds very reasonable, and the reason we believe them isn't because they're true, but because we need to believe in something to keep ourselves from feeling chaotic. Sometimes people don't need the truth, they need certainty. And if there's no certain truth, they'll choose the story that sounds most certain. This is why fake news, conspiracy theories, and miracle financial advisors persist, despite being disproven again and again. They tap into a very human need. Give me a reason not to feel powerless. We grow up in a society that teaches us everything has a cause, that with facts there will be answers, with charts there will be forecasts. But reality in finance and in life isn't that neat. The world doesn't operate in straight lines. It operates in a tangled chain of crowd psychology, personal emotions, random variables, and unannounced turns. And in that context, if you try to force everything into a rational framework, you will be deceived by your own beliefs. After the 2008 crisis, hundreds of books were written to explain what happened. Each book had its own explanation: Wall Street greed, banking system failures, policy mistakes, excessive consumption. All sounded plausible. But if there was truly one correct explanation, why does the market keep repeating similar mistakes? Because those explanations, while perhaps partly true, are stories told after everything has already happened, and humans are very good at finding reasons after the consequences are laid bare. The harder and more important thing is to accept that some things have no rational explanation, or at least not yet, or too many explanations to choose the right one. And if you cannot live with that ambiguity, you will easily cling to any available truth, even if it's wrong. Successful investors aren't those with unshakable beliefs, but those with the ability to continuously doubt and adjust, unswayed by promises of certainty. And this is the biggest lesson in finance. Uncertainty isn't something to be eliminated, but something to learn to endure. Like someone living in the wilderness, you can't control the weather, but you can learn to pitch a tent. You can't stop wild animals, but you can carry fire and a knife. You don't need to know all the answers. You just need to be alert enough not to quickly believe the first story you hear. Personal finance isn't a memorization contest, it's a journey of survival. Survival in the market, survival in your emotions, and survival in a world where very little goes as planned. Morgan Housel doesn't promise a formula for becoming rich. Instead, he offers small principles strong enough to accompany you for decades. 1. You don't need to be a genius to get rich. You just need the right attitude towards money, respecting risk, being humble before the future, patient with results. 2. Saving is a superpower. You can't control the market, but you completely control your spending. Someone who spends less than they earn will have more freedom. 3. Don't try to optimize everything. Striving for perfection makes you fragile when unexpected events occur. Reasonable and sustainable is always better than optimal but fragile. 4. Leave room for error. A good financial plan isn't a 100% correct plan. It's a plan that survives 100% of unexpected variables. 5. Understand who you are and what you want. Don't invest like others. They don't live your life. They don't have your fears and dreams. 6. Patience is the rarest thing in a fast-paced, short-sighted world. The one who knows how to wait is the one who wins big, and the big winner doesn't need to win frequently. 7. Pessimism spreads easily, but optimism creates the future. Every crisis is a psychological test. If you pass, the reward will come. 8. No one knows anything for sure. If someone claims something is always true, step back a few paces. Humility is the best filter to protect you from risk. 9. The story you believe is more important than the facts you know. Choose stories that keep you calm, disciplined, and committed to your long-term plan. 10. Wealth is having a lot of money, but happiness is when you are not controlled by money. Don't confuse the two. I wrote an entire book about how to deal with money intelligently. But personally, there are things I do not because they are intelligent, but because I am human. For example, Morgan Housel doesn't have a detailed spending budget like many experts advise. He knows his income, knows he saves enough, and that's sufficient. Others might need detailed Excel spreadsheets. He keeps some money in a savings account even though interest rates are low, simply for the feeling of security that comes with readily available cash. From a purely financial perspective, that's a bad decision. But from a personal psychological perspective, it's the right decision. Then he recounts, "My wife and I paid off our entire mortgage even though the interest rate was only 3%. He knew if they invested that money, the returns would be higher. But what they bought wasn't efficiency, it was peace of mind, the feeling of owing no one anything. And this is the most important confession. We didn't aim to become the richest people. We aimed for financial independence and peace of mind." If you are too enamored with the theoretically best option, you might miss the good enough option that is suitable and sustainable long-term. There are times I've invested incorrectly, held cash for too long, didn't maximize returns, but I still sleep well. I still live true to my values, and I think that's what matters most. Choose a path that allows you to live in harmony with yourself without needing to explain to anyone.